main focus point today concerns this topic: why investors who trade more often tend to make less. And Warren Buffett said for years that investors often shoot themselves in the foot by trading too frequently. Okay. And trading too frequently can certainly trigger tax implications. So that's one big aspect to it. But the other is just simply chasing returns. And this is something that everybody is prone to. It is part of being humans. We are emotional beings, okay? And that's the first aspect of being a good investor, is being honest with yourself. Being honest with what it is to be a human being. To feel those emotions when the price of something you own goes up or down. We know that people feel worse, way worse, twice as worse or more when something drops 5% than when something goes up 5%. And that's just part of being a human. But you also feel terrible when you talk to your friend, your cousin, you read an article, you see somewhere where somebody else besides you is making a lot of money and you missed out. FOMO. That's the greed aspect. There's the fear and the greed, and it manifests in different ways. And so when you get too caught up in trading and chasing the winners, you certainly set yourself back. And there's a classic study, and it found that households in the top trading activity quintile, meaning the top 20% of households that trade the most, underperform their low turnover peers. I mean, the ones that are in the bottom 20%. By almost 7% a year. And this is simple behavioral finance research. It's been around for decades. Those that tend to trade heavily tend to chase the past winners. And then they sell the losers. And what happens often too is it's done really well. They chase the winners, and they feel they don't pick the top, right? They buy before the top, and they're making money for a little while, but they don't know when to get out, and they're not buying it because of some fundamental underlying value. They don't understand that. Okay, it's just a narrative. It's just what is in vogue at the time. AI is a good example right now, and you can do well for a period of time, but most of them eventually revert to the mean, revert to reasonable valuations. And by that time, these investors or traders sell at a loss because they waited too long. And they overestimated their informational edge. They thought they knew different. Especially when you buy and you're successful over the short period of time. But we know investing isn't about the short game. It's about the long game. And the National Bureau of Economic Research concluded that frequent trading can be beneficial for some households. But it's not about chasing the winners. It's about rebalancing, managing risk, harvesting tax losses, rather than trying to outsmart everybody. So what this is saying is trading isn't the enemy. It's trading without a plan. It's trading without a purpose. If your purpose is just, I want to make more money and I want to play this trend that's happening right now, well, it's kind of like a casino, right? At the casino, you can go sit down at the blackjack table and you're up, right? You might sit down, you might have a string of luck and you're up. But the smart people know that at a certain point, you need to get up and walk away. You need to bank those gains because the numbers don't lie. Over the long term, the casino wins. What's good about the investment markets is if you stick to sound principles, you can put the odds in your favor, and over the long run, you win. It's flipped on its head, right? Those that just try to play those short-term trends are unlikely to pull the trigger at a time that is advantageous to them, to walk away from the table that's advantageous at a time when it's advantageous to them. What's more likely is that sector, that theme will roll over. They won't get out right away, right? And hold on too long and then sell near the bottom. So understand this and be honest with yourself and make sure you don't fall victim to these pitfalls.